Good morning, guys. Today we're going to be looking at the Cleveland Cliffs third quarter earnings call. I'm very excited to watch this one. I've been seeing a lot of people talking about the earnings. I think it's from what I've read so far, it looks pretty good, and I'm excited to read about the rest of it and see the earnings call, what questions get asked. I'll just go, let me pull this something up real quick, and then I'll go into the main numbers I think you got to look at. The main numbers you got to look at here. And this is going to be the most crucial part for this video. Here we go. Alright, I'm getting it up. All right, so as we've seen, the pre-market price has been going up. I think the main things you want to look at here is that for Q3 2025, we could see the steel shipments at 4.0 million net tons, consisting of 37% hot rolled, and then this is kind of not too important, but the consolidated revenue of 4.7 billion, which is obviously down from Q2, but that was expected, and the GAAP net loss. It's a company where I'm watching. I really want to see it start making that turning point and start to create revenue, create a business model that is sustainable, because it's hard to run a business that is not making any profit, and it's been a while now. We've been waiting for a while for profits to start coming in, all that stuff, and it's the main thing I'm kind of watching for. With the EBITDA improvement, although still unprofitable on a GAAP basis, I think the move from 94 million in Q2 to 143 million in Q3 is a strong step in the right direction. And shipments are holding up. There's 4 million in net tons, shows volume isn't collapsing despite industry headwinds. And not only this, but I think the cost discipline and guidance tightening is very important, because CLF reduced its full year CapEx guidance to 525 million and SGA to 550 million, which signals management is serious about improving profitability. I think the profitability is the main issue we have as this company continues to grow, and it's going to be the main thing that will hold back the company in the near term, the short term, however you want to say it. I don't know why they got to play the worst music always for these calls in the pre-call. Long story short, though, I think with the better mix and the automotive exposure, the company's CEO has cited improving automotive grade steel demand and multi-year supply deals with OEMs, which improves the marginal potential. Obviously, we've seen they're still in loss, and even though adjusted loss improved, GAAP loss remained large and the business remains very challenged. The pricing squeeze risk is that the average selling price per ton was 1,032 versus higher level last year, which shows that there's pressure on margins remains. Also, one thing I want to point out is how cyclical a business like the steel sector is, and the steel industry remains vulnerable to global overcapacity and demand slowdowns, which is especially seen in the auto and infrastructure. I don't know. Something just in the auto and infrastructure industries. It's very it's very common to see demand slowdowns, especially as we move into the winter, and raw materials are constantly swinging in price demand. Even though revenue was weak and the company is losing money, the improvement in EBITDA, cost controls, and the signs of recovered demand seems to have way more for investors right now, and that's why I think the stock is continuing to rise in pre-market. We've seen it's topped at around $15 a share, and I think the main things you want to watch are the automotive demand. How solid are the multi-year OEMs deals? Are the volume ramping or just getting booked? Pricing trends, I think that's another thing you're going to want to have to watch. What management is seeing for steel nets selling price per ton in Q4 and into 2026. The guidance is going to be very important on this one, especially for a company that still has yet to turn a profit. Also want to look for the cost structure improvements. Are the $50 per ton net cost reductions mentioned in the guidance realistic and sustainable? And how do they plan on implementing that? How does that kind of work? Also, I think the CapEx and the cash flow, with CapEx cut and losses still present, when will CLF generate free cash flow? It's one of the main problems for all investors, I think, and it's one thing that I think that they've still yet to really answer, and how they're going to be able to turn it into a profitable business. And another thing I think is the diversification and the M&A. The company mentioned a memorandum of understanding with a major global steel producer and exploration of rare earth mineral opportunities in Michigan and Minnesota. I think that could be a huge catalyst if it develops, and I'm excited to see what is kind of being said about that, what they believe to be the future with that, and what that kind of means for the company. Also, I want to hear their thoughts on the macro economy. What's their thoughts on the steel import risk, the U.S. manufacturing activity, infrastructure spending, and global oversupply of steel. So, yeah, I think the call is about to start. It's just turned 8:30, so I'm going to chill out here, watch the call. Any questions, drop them in the chat or in the comments below if you're watching this as a video, and I'm sure I'll get to them soon. I think this isn't the worst earnings I've ever seen. It's definitely not great, but it's not something that I would be like too upset about as an investor. And they're going to keep playing music on me? I want to see something else, man. Stock is still up in the pre-market too. Ooh, pushing up. I think the rare earth is going to be a big thing. I want to see what they say about that.
Good morning, ladies and gentlemen. My name is Donna, and I am your conference facilitator today. I would like to welcome everyone to Cleveland-Cliffs' third quarter 2025 earnings conference call. All lines have been placed on mute to prevent background noise. After the speaker's remarks, there will be a question and answer session. The company reminds you that certain comments made on today's call will include predictive statements that are intended to be made as forward-looking within the safe harbor protections of the Private Securities Litigation Reform Act of 1995. Although the company believes that its forward-looking statements are based on reasonable assumptions, such statements are subject to risks and uncertainties that could cause actual results to differ materially. Important factors that could cause results to differ materially are set forth in the reports on Forms 10-K and 10-Q and news releases filed with the SEC, which are available on the company website. Today's conference call is also available and being broadcast at clevelandcliffs.com. At the conclusion of the call, it will be archived on the website and available for replay. The company will also discuss results excluding certain special items. Reconciliation for Regulation G purposes can be found on the earnings release, which was published this morning. At this time, I would like to introduce Lourenco Goncalves, Chairman, President, and Chief Executive Officer.
Thank you, Donna, and good morning, everyone. Our third quarter results were a clear indication that a significant rebound in domestic steel demand has started, and the automotive sector is leading the way. It's now widely accepted and understood that tariffs are here to stay, particularly the Section 232 tariffs on steel, autos, and derivative products. These tariffs are not a negotiating tool. and the only effective way to avoid tariffs is manufacturing in the United States.
In the U.S.
With all that, third quarter was our best auto steel shipment quarter since the first quarter of 2024. That's a very encouraging sign for what's coming in 2026 and beyond. Over the past quarter, Cleveland-Cliffs was able to lock in 2 or 3 year agreements with all major automotive OEMs, covering higher sales volumes and favorable pricing through 2027 or 2028. These are not small renewals. These agreements represent strategic commitments to domestic steel sourcing by the most relevant auto OEMs. Many of these customers have told us directly that they want to reduce their exposure to tariffs and to foreign volatility. They want stability and resilient supply chains. With a total of 9 automotive-grade galvanized steel plants, 5 of them designed to produce exposed parts in all specs and widths, Cliffs is the natural partner for the car manufacturers expanding production in the United States. President Trump's trade agenda has steel and automotive as part of its core. These two sectors are not just economically relevant, they are fundamental to national security. Rebuilding this strength is essential to sustain America's industrial independence and to improve our national defense readiness. The same industrial base that builds advanced vehicles and powertrains for civilian use, supported by domestic steel production, can also provide the engineering capability, supply chain depth, and logistics expertise required to support the American military. There is no question that the resurgence of the U.S. auto sector, supported by domestic steel, is a matter of great urgency. While other steel companies are still building or promising to build new capacity to be ready in 2028, 2029, or later, Cliffs is ready for 2026. Our state-of-the-art automotive-grade galvanized steel plants, Spartan and Dearborn in Michigan, Middletown, Cleveland, and Columbus in Ohio, and Rockport, Indiana Harbor, Burns Harbor, and New Carlisle in Indiana are all up and running. Cliffs has plenty of capacity right now, and the multi-year contracts we have signed with our automotive clients should give us the demand we need to make all these plants work at full capacity and at full employment levels. This quarter also reminded the automotive OEMs why steel, and Cliffs steel in particular, is irreplaceable. When lightweighting became a major trend several years ago, some automakers jumped on the aluminum bandwagon, chasing immaterial and expensive lightweighting gains, while ignoring very meaningful technological advances in the production of high-strength steels and, more importantly, the enormous supply chain risks they were assuming. A huge fire at the nation's largest automotive aluminum producing mill this past quarter revealed the fragility of that shift. Vehicle models that were years ago moved away from steel and toward aluminum are suffering the most. The silver lining is that switching back to steel is now under serious consideration by the most affected OEMs. Recent trials of conforming parts with our steel using equipment originally designed for aluminum are showing very promising results. This is a huge win for American-made steel and a validation of everything we have been saying for years. Domestic steelmaking, and particularly Cliffs steel, is the backbone of the American automotive supply chain. We fully expect that aluminum's participation in the automotive space will continue to shrink, with Cliffs being the biggest beneficiary of the trend. The resurgence of U.S. manufacturing, enabled and supported by the Trump administration, has made Cliffs very attractive to a number of major global steel producers. These steelmakers supply steel within their respective countries to important clients, and these clients are now moving production to the United States. Exporting steel into the U.S. is no longer a viable option for these foreign steel companies. Like their steel-consuming customers, these folks need a physical presence in the United States. Cliffs is a fully integrated steel company, starting from mining iron ore and going all the way downstream to the production of high-end finished products. And that is all based in the United States. This foreign interest in Cliffs is fully aligned with President Trump's agenda of strengthening America's industrial base and attracting foreign investment. With all that, a few months ago, we were approached by a major global steelmaker who wants to leverage our footprint in the United States to enable a smooth onboarding for their downstream industrial clients moving production from their country of origin to the United States. During the third quarter, we entered into a memorandum of understanding with this global steelmaker, and we expect to make a formal announcement in the next few months. I will not take any questions on this subject today.
Oh, man.
Separately, we have made excellent progress selling profits that no longer fit into our production footprint. I am pleased to report that we are under contract or agreements in principle for 8 of these sites, with a combined total value of $425 million.
That's a lot.
The proceeds of these sales will go directly toward debt reduction. As for our larger operational asset sales process run by JP Morgan, this is currently being deprioritized given the comprehensiveness of our MOU with the global steelmaker. We are not quite pencils down on this process, but advancing our negotiations under our MOU is now our top priority. While our U.S. business is on a clear path to recovery, we complete on November 1st our first year of ownership of the Canadian steel company Stelco. The picture in Canada remains disappointing. Roughly 9% of our total sales come from Stelco in Canada, and that market continues to lag our expectations. There's only one cause to the problem. The Canadian government has been completely unwilling to act against dumped steel into Canada. Imported steel penetration into the Canadian market stands at a ridiculous and absurd 65%. The Canadian government could easily resolve the problem by replicating what the United States has done under Section 232. Impose meaningful tariffs, close loopholes, and enforce the implementation of these anti-dumping countermeasures. With other regions of the globe moving in the right direction, even the European Union has recently tightened its quota and tariff regime. Canada stands alone in doing nothing. A bailout loan as the one given by the Canadian government and the province of Ontario to Algoma, one of our Canadian competitors, is not a fix for the problem.
Oh, it's going to hit 15.
Trying to weaken Section 232 in the United States just to bring back Canadian steel into the American market is even worse. Stelco, under our ownership, does not want to and should not depend on selling steel into the United States
I like the
for its
CEO.
survival. Stelco could thrive exclusively by selling steel in Canada. While
15.
I confess my inability to convince the several Canadian government officials I regularly speak with, I continue to expect Prime Minister Carney to make a move in the right direction. Let's see how long it takes, or if I will need to be more persuasive. Meanwhile, the U.S. government continues to grow as our partner. During the quarter, we were awarded a 5-year, $400 million fixed-price contract by the Defense Logistics Agency of the U.S. Department of War. This contract covers up to 53,000 net tons of grain-oriented electrical steel, which the U.S. government intends to store for national security purposes. The award underscores Cliffs' position as the only U.S. producer capable of supplying this critical material, GOES, grain-oriented electrical steel, further reinforcing the strategic importance of our electrical steels to the nation's defense and energy infrastructure. Also, we recently learned that our 2 projects receiving grants from the Department of Energy at Middletown, Ohio, and Butler, Pennsylvania, were not included on the cancellation list that ended more than 200 other projects. As such, we will proceed with the Butler project on schedule, and we will also continue to work with the DOE on the new scoping of the Middletown project, which is critically important, as that blast furnace will be reliant in the next 4 to 5 years. Last but not least, the growing strategic value of rare earth elements has prompted us to revisit this potential within our mining portfolio. We view this effort as both an opportunity and as our responsibility. Comprehensive reviews of our ore bodies and tailings basins have identified 2 sites, one in Minnesota and one in Michigan, where geological surveys show evidence of rare earth mineralization. We continue to assess our potential on both sites. Advancing this initiative will position Cleveland-Cliffs squarely within the nation's pursuit of critical material self-sufficiency. We believe America's industrial foundation must never depend on China or any other foreign source for essential minerals. Cleveland-Cliffs is committed to contributing to our independence from foreign powers on critical materials. With that, I will turn to our CFO, Celso Goncalves, for his remarks.
Thank you, and good morning, everyone. Our third quarter results were driven by steady operational execution and much better than expected pricing, supported by automotive strength. Our adjusted EBITDA in the quarter improved to $143 million, a 52% increase over the prior quarter, driven by margin expansion from higher realized prices and improved mix. Our steel shipment volumes were 4 million tons in the quarter, a reduction from the prior quarter as a function of summer slowdowns and our continued discipline in the broader market. Fortunately, as a result, our mix shifted favorably toward automotive, which drove our average selling price to $1,032 per net ton, up $17 per net ton over the prior quarter. This improvement in price is entirely driven by automotive shipments moving from 26 to 30% share, and coated volumes moving from 27 to 29% share. On the cost side, we continue to deliver great results as our unit costs adjusted to the much richer automotive mix. Our continued cost performance was almost entirely driven by the footprint optimization activities we announced earlier this year and have fully implemented at this point. The third quarter was the first full quarter we operated with these operational efficiencies in place, and our projected annual savings of $300 million from these maneuvers remain on track. We also continue to take further action to reduce both SG&A run rate and capital expenditure budgets. Our CapEx budget for 2025 is now $525 million, down from our original expectation to begin the year of $700 million. This is reflective of dramatically reduced spend at Stelco, as well as the now changing DOE project at Middletown. In addition, full-year SG&A expectation is now down to $550 million from our original expectation to begin the year of $625 million. These savings are reflective of overhead and incentive pay cost cuts in response to weaker demand conditions. Another upcoming item to highlight is the December 9th expiration of our onerous slab contract. For the past 5 years, we've been bound by a contract that valued imported slabs using the now irrelevant Brazilian slab index. That index no longer reflects the real cost or value of American steel, much less the value of our automotive-grade slabs produced at Indiana Harbor. With the contract expiring, we will reclaim that production internally, using our melted and poured slabs to serve growing automotive demand. This past quarter, we also took advantage of the strong high-yield market and refinanced the entirety of our remaining bonds maturing in 2027, leaving us with a runway of more than 3 years with no upcoming bond maturities. Our next bond maturity is not until March of 2029, and those notes can be redeemed at par starting in March of next year. Together with the outstanding balance on the ABL, we have plenty of prepayable debt to pay down with the incoming proceeds of property asset sales and future free cash flow. Our gross debt amount remains elevated, but we will have ample opportunity to pay it down over the coming quarters. That said, the composition of our debt and maturity runway leaves us with plenty of flexibility going forward. The primary end markets that we serve, transportation, manufacturing, and construction, have been experiencing recession-like conditions over the past 12 months. We have navigated this with our operational improvements, footprint optimizations, and reductions in overhead and capital costs. The construction and general manufacturing sectors still remain relatively weak, but if history is any guide, those sectors will follow the trajectory of the automotive sector, which is now tracing upward. We have finally started to see a bit of restocking activity in the distributor and end user markets, an indication that the new tariff reality for those buyers is setting in. The signs of a real recovery are forming, and we need consistent demand and stable policy to keep it going. Once these policy changes give us the demand boost that we need, the foundation that we have laid with these operational improvements will propel us further to amplified EBITDA and cash flow. With that, I'll now turn it back to Lorenzo for his closing remarks.
Thanks, Celso. Q3 showed the first clear signs that the tide is beginning to turn. Automotive is rebounding. Our cost actions are working, and trade policy is delivering measurable results. But we are not declaring victory yet. We can and will do better. Our onerous slab contract will soon go away. Our automotive volumes will continue to increase, and we will finish what we have started. That includes the execution of the final agreement and the beginning of the work, which will follow our transformational memorandum of understanding with our major global steelmaker partner. With that, I'll turn it back to Donna for questions.
Thank you. The floor is now open for questions. If you would like to ask a question, please press star 1 on your telephone keypad at this time. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up the handset before pressing the star keys. Once again, that is star 1 to register a question at this time. Our first question today is coming from Nick Giles of B. Riley Securities. Please go ahead.
Thank you very much, operator. Lorenzo, Celso, good morning, and really nice to see all of these updates. Cliffs has been a national champion in the U.S. metals and mining industry for over a century, so it's really good to see you taking the initiative on the rare earth side. My question is really, how quickly could you produce products in this vertical, and could you look to be a vertically integrated producer, or would you look for a partner? Thank you very much.
Thanks, Nick, for the question. Look, we have the opportunity to develop the mining, assuming that all these original studies will play out as we expect, and we'll go from there. It's very clear that the U.S. government is very quickly realizing the importance of having an industry for this type of minerals inside the borders of the United States. And that's also, in my opinion, an opportunity for cooperation with Canada, another unexplored opportunity that we can develop with our northern neighbor. So there are several ways to go with this thing, and the important thing is that the geographical location would be good for both. We can do it inside the United States, we can do it in Canada, because we're very close, across the pond, across the Great Lakes. So it's very easy to work within the United States or with Canada. But these are the two options I see going forward.
LG, thanks for that detail. Maybe just as a follow-up, what resources have you brought in to date to explore the opportunity, and when is kind of the first mile marker in terms of a potential product mix or any economics? Should we be thinking about something early next year? Appreciate any color.
Look, we've identified two sites that have the most promising. We are working with geologists to assess whether these deposits could become commercially viable. That's where we're at. And don't forget, as you said, we are a mining company, so this is not new territory for us. We understand mining into these lands more than anyone, because we have been doing for a long, long time. And we will see how we'll go from there. But that's a potential that we will not let go without putting a lot of effort and a lot of ingenuity into getting this done inside the United States or in partnership with Canada that has experience in mining these not so rare elements that are called rare earths.
Man, the stock's going up a lot.
LG, thanks again.
I think these are some great answers, and I think it's really complementing the steel business with the rare earths metals.
Thank you. Our next question is coming from Mike Harris of Goldman Sachs. Please go ahead. Mr. Harris, please make sure your phone is not on mute. We'll move on to the next question. The next question is coming from Lawson Winder of Bank of America. Please go ahead.
Thank you very much, operator. Good morning, Lorenzo and Celso. Thank you for today's update. Could I ask just about your decision to deprioritize the asset sale process? How has that process gone to date? And then has there been any interest, and if so, in what assets?
Look, like I said, the process, we did not stop by any stretch. Actually, we closed on a portion of the sale of FPT during the weekend. So we didn't close. We have a signed contract. I misspoke. It's not a closing yet, but it will be a short closing. And the portion that we sold on FPT is not even a site that we explore for our own EBITDA. So it doesn't change at all the EBITDA that you generate from FPT. So we're very pleased that we had more than one part interested on that specific portion of FPT, including the Florida assets. And we are very excited with the opportunity to continue to sell the remaining portions of FPT as we go. The other asset, Lawson, that we're considering selling would be our direct reduction plant in Toledo, Ohio, because as you might conclude on your own, but I will reiterate here, we have no interest in building a flat rolled mini mill ourselves. I was keeping that HBI plant to supply Big River in case we had the opportunity to acquire U.S. Steel, which did not play out. So as we did not acquire Big River through the acquisition of U.S. Steel, I don't see any specific strategic value of keeping a direct reduction plant producing HBI with the strict goal of supplying flat rolled mini mill, producing more of a high-end type of flat-rolled products. That's not my problem anymore. So we still have a lot of interest in that specific plant, but this discussion with the MOU and the subsequent work that we're doing with our partner is showing that we might be doing other things with that plant, which I will not elaborate at this point. So I'm kind of still considering alternatives, but I'm deprioritizing that because the MOU trumps, no pun intended, trumps the opportunity of selling itself as a standalone unit, the Toledo plant.
The CEO is really well spoken.
That's very clear. If I could just follow up on your comment on FTP. So should we be looking for some sort of announcement on that sale of a portion or partnership?
I just made it. We are under agreement to sell the Florida assets to SA Recycling. So, and that's the deal. So it's out. I just said it to you.
Can you provide any detail on economics at this point, or is it too early?
No.
Okay.
But it's good.
Thank you for that.
It's good. And if you apply a multiple to a site that generates zero EBITDA, you can pick one.
Okay.
So it doesn't change the economics of the rest. That's the importance of this sale. That's why I'm disclosing. That was an asset that for me was always completely relevant because I'm not going to put a mini mill in Florida to produce rebar or anything else. So that was not a site that I was interested from the get-go. It came as an addendum to what I was really interested in having, the real FPT, the FPT around Detroit and around prime scrap, and that's completely preserved. And there are other companies, more than one actually, interested in acquiring the rest. And they both have the same thing in common. They don't want Florida. So we moved Florida. But we're not going to reveal the number, but the number is extremely good, and you'll see in our liquidity going forward. But you got to wait because this is just a signed agreement. It's not closing yet, so we can't disclose the number.
Yeah, understood. All right. Thanks very much for your responses. I appreciate it.
Thanks, Lawson.
Thank you. The next question is coming from Phil Gibbs of KeyBanc Capital Markets. Please go ahead.
Hey, good morning.
Morning, Phil.
Question is on the auto contracts. Did any of the new contracts kick in during this quarter, or do any of the new contracts kick in during the fourth quarter?
Yeah, we have some kicking in October 1st. I'm simplifying when I'm saying 2026 because, it's a short quarter. Fourth quarter, particularly in automotive, is not a quarter that we are excited about because we're going to have shutdowns through the end of the year. That's normal course. Sometimes we have, I'm not sure about this year because they're really busy, but it's normal course for them to shut down around Thanksgiving as well. But we're going to see a lot of activity coming from these contracts as the year turns to 2026. So we're super excited with everything that's happening with General Motors, Ford, Stellantis, with this big announcement of $13 billion bringing back the plants that we were by far the largest suppliers. So all these things are coming to us at this point. We have Ford, we have Hyundai, you have Honda, we have Toyota in North America. These are all happening. And the good thing, Phil, is that the car manufacturers finally realize that it's not a good thing to wait and seeing that the Trump administration is not changing their tune. I think Secretary Lutnick was very clear when he said the United States will be first in producing automobiles. Canada can be second. So that shows resolve. So I like to see that, and that helps us in terms of getting our business moving in the right direction. So we are good.
And then just a follow-up on the cost side, what does the guidance imply for further unit cost reductions in the fourth quarter, and should we expect any more momentum in the first part of 26? Thank you.
I'll let Celso handle this one, Phil. Please, Celso.
Yeah, sure. Hey, Phil. If you look at the cost performance in Q3, adjusted for the increased automotive mix, we still expect costs to be down $50 a ton year over year when adjusted for this mix. You can see in our track record achieving cost reductions dating back, to 2023. We achieved an $80 a ton cost reduction in 23. We were down another $30 a ton in 24. And then now in 25, our unit costs are still expected to be down $50 a ton. So we're not changing the guide there. Just as it relates to other Q4 kind of talking points and general guidance that I can give you, shipments should be similar as Q3, around 4 million tons. You have to consider seasonality with the holidays, offsetting improved demand. Auto shipments are expected to be similar. And then in terms of pricing, you probably have all the pieces that you need to calculate as the ASP for Q4. So relative to Q3, Q4 cost should be relatively similar to Q3.
Thank you.
Thanks, Phil.
Thank you. Our next question is coming from Carlos de Alba of Morgan Stanley. Please go ahead.
Yeah, good morning, Lorenzo and Celso. Thanks for the update. Just on following up on the auto contract, can you maybe give us some comment on the volume growth implicit in this new agreement and potentially an indication of how much pricing may be moving up or down or staying flat? Definitely a very important piece of the business going forward.
Look, we directionally, these contracts will generate a lot more margin for us, including margin per ton. And that's all I can share at this point with you. These are good contracts. But
what a great quarter.
We realized one thing, Carlos, that probably has been missed throughout this entire conversation. And I'm trying to, in my prepared remarks, and now using your question, so thanks for the question. I will try to explain a little bit about what Cleveland-Cliffs really is in terms of the automotive industry. We hear a lot about market share in automotive, gaining market share, losing market share. Let's understand one thing. Cleveland-Cliffs has so much more capacity to produce the steels that the automotive industry needs in comparison with any other supplier or any other wannabe supplier of automotive steel, that it's not even a topic of conversation talking about market share, about these type of things. We have 5 plants, full plants, that are ready to supply a lot more exposed parts than we are supplying right now. Not because we lost market share, but because the car manufacturers were producing cars in places like Mexico, Canada, South Korea, and I'm talking about American car companies, even in Japan, American car companies. So that's the absurd of the entire thing. And that's what's being corrected. So as they are being compelled, in the lack of a better term, to produce cars in North America, in certain cases like Stellantis, they are coming to senses and coming back to the reality that North America is their main market and Cliffs is their main supplier. We are seeing the business coming back and coming back extremely stronger. Just to give one set of numbers for you to think. Columbus Coatings, it's one galvanizing line ready for extra wide exposed parts that produce today something between 280,000 and 300,000 tons a year. The line itself is able, as is, to produce 450,000 tons just by putting more throughput through the line, and that is coming. And the site itself is perfect to double in terms of the capacity in that specific site because we have room to put another line side by side with the existing one to double from 450,000 to 900,000 tons. That's on a single site. And we don't need to invest to put the new line because we have idle capacity in Dearborn. The downstream Dearborn is the most modern galvanized steel plant in the world. It was built in 2013 by Severstal and acquired by AK Steel, and then we acquired AK Steel. So Dearborn is ready for more. Middletown, same thing. Rockport needs to be visited. It's all robotic. It's all automated. Has been like that for at least another 1 or 1.5 decades. So it's there. In New Carlisle, that used to be called IN Tech, IN Coat by Inland and Nippon Steel long ago, is pretty modern and pretty well equipped to produce not only hot dip galvanized and galvanneal, but also electro-galvanized, as well as Middletown. So we have and that's just exposed. If you go to non-exposed, high-end non-exposed, you have Cleveland. Cleveland Works is the most technologically advanced mill to produce high-strength low alloys for the structure of cars here in the United States, and we have been doing that, but we have capacity for more. So that's prevalent everywhere. Indiana Harbor, Burns Harbor, our joint venture with Worthington Steel, Spartan, same thing. So that's 9 plants ready to grow as is or adding capacity as needed in the next 3, 4, 5, 6 years. So this movement that was initiated by President Trump that will percolate for the next 5, maybe 10 years will be all supported by Cleveland Cliffs. And I'm explaining to you the capacity. So I'm not going to go into these little details on how much more the contract or this and that. These things are coming now as a wave of a new business that we are ready to take right now. Sorry for the long answer, but it was a good question. I decided to use it to explain details that probably are not well understood, but I hope after I made that explanation we'll at least generate more questions that will keep us helping clarify the subject.
Oh, great. Thanks for the additional information. And then talking about the other opportunity that just came up for Cliffs on the rare earth space, are there any details or early details that you have in terms of the type of mineralization, rare earth mineralization that you may have, and what type of minerals potentially you could be producing? And also, is there a timetable for a feasibility or pre-feasibility study or preliminary economic analysis assessment? Sorry.
Look, I don't think that I want to talk about yttrium, dysprosium, or terbium, or cerium, or lanthanum, or neodymium, or praseodymium in this call. But I am a chemistry person, so I would love to, but I don't think that would be a good thing for us today, Carlos. Let's take this offline and let's discuss. The important thing is that they are there. We found them there, and we want to make it viable. We really believe that we have potential there, and that will be good for Michigan, for the Upper Peninsula primarily, and there's even one site in Minnesota that we would go. Minnesota is not very friendly to us, but we still we investigate there. But we definitely will start in Michigan, in the Upper Peninsula, because we love the Upper Peninsula.
All right. Thank you, Lorenzo. Looking forward for that conversation on more details when available.
Yes, sir. Thank you.
Thank you. Our next question is coming from Mike Harris of Goldman Sachs. Please go ahead.
Okay, let's try this again. Hopefully you can hear me this time.
Very well, Mike.
Hey, how you guys doing? Hey, just wanted to follow up on the electrical steel award that you highlighted, and just to kind of help us, how should we think about that? Is that more of a kind of a one-time opportunity, or is this like the first of that?
It's a one-time opportunity, Mike, but it's a multi-year one-time opportunity. The U.S. government, the Department of War, made the decision to put in storage a safety reserve, strategic inventory of this type of materials that we produce. So we are going to build that inventory together with the Department of War. And we are very proud of this partnership. It's extremely good in terms in economic terms and in the long-term viability. Of course, we're going to prioritize that because it's national security, and it will take years to finish. And this probably is this first move into a direction that it's clear that the Trump administration is taking in terms of protecting the country with strategic inventories of things that could be under attack in a moment that's not very peaceful in the world. So it's all good, and we are proud of our partnership with the U.S. government, and particularly with this specific deal.
Okay, that helps. And then just a follow-up to it, and I think, Celso, just a few minutes ago, someone asked a question around the cost reduction effort, and you kind of pointed out the track record. And I guess I was just curious, what we're witnessing here, is that just you guys now having the opportunity to take out maybe stranded costs from the acquisitions, or are we seeing the benefits from, some process improvement?
I think it's just benefits overall.
Just kind of help
stabilizing.
Help me understand what we're witnessing with the cost reduction effort here.
Yeah, sure, Mike. Thanks for the question. Yeah, I think, over time, we've been proactive in terms of optimizing the footprint. We became a steel company in 2020, if you remember. We acquired AK Steel. We closed that deal March 13th of 2020 in the middle of the pandemic. And then we doubled down and we acquired the ArcelorMittal USA assets in the same year, closed in December 9th of that year. And for the subsequent years thereafter, we became a major steel company sort of overnight, and it took time to optimize the footprint. It came with a lot of assets. Many of them were very good. Some of them weren't so great. So over the last few years, we've been prioritizing, optimizing the operations across all of our assets. And that's what's really driven the accomplishment on the cost side. And this year was really the completion of those efforts.
Okay, that helps out. Thanks a lot, guys, and good luck and continued success.
Thank you, Mike. Appreciate it.
Thank you. That brings us to the end of today's question and answer session. I'd like to thank everyone for their participation today. You may disconnect your lines and log off at this time. Enjoy the rest of your day.
All right, that was a very strong call, very strong quarter in general. I think the main things to look at is it was obviously a mixed report. We expected that coming in, but obviously the market's reacting to it very positively. I think the main thing is that the EBITDA jump that we saw from 94 million to 143 million, it shows clear improvement in their margins and cost control. The big takeaway, I think, is that Cliffs is finally stabilizing. They're obviously losing money on paper, but management is tightening expenses, locking in the multi-year auto deals, which I think are going to be absolutely massive for the future of this company. They're winning the government awards, which are also going to help the company massively. I think this is going to be a like guiding towards stronger cash flow heading into 2026, and they may finally be able to turn profit. Um, Personally, I think the market is pricing this all in. I think it might even hit 17 today, because how good would this call really was. I think someone in the chat said, "Is this a buy?" I think if you believe in the steel industry, it's definitely a buy. Of course, you got to watch out because it's such a cyclical company. Even he said next quarter is going to be worse than this quarter, and it's always like that in the winter. And it's a tough company to be investing in, especially with how volatile the steel prices are. But this is exactly what you want to see in a cyclical name, because it's operational discipline. They've started to cut down on the cost, and not only this, but they've been resilient with no one expected them to really come back after how much losses they've been making, and how much the Canada deal was scrutinized. I saw the CEO was being thrown in the trash. This is the first earnings call I've listened to from them, and I think the CEO is one of the best CEOs on the market realistically right now. I don't think anyone else is really analyzing their company as well as him, as knowing how to answer the questions. I mean, one of his answers was like 5 minutes, and all of it was good information that it may look confusing now. I'll probably reread the transcript after this and see exactly what he was saying, because it was so much to process at once. But it sounded very good, and I think if if you're investing into this company, I think you're doing very well right now. I think you're going to continue to do well, because this seems like a company that will continue to grow, at, especially with the average selling per ton at $1,000. It's there's obviously going to be pressure on margins. They're still in a loss, and the steel sector is a tough one. But I think you got to be watching this automotive exposure, especially as he cited they're improving their grade steel demand. And he was right on when he said car companies are not able to produce steel at the levels that they require. And even if they try to, the raw material cost it's impossible, and they need to use a company like Cleveland Cliffs, and I think it will always have a place in the market. Despite the revenue miss, I think this is a great investment. If you found this breakdown helpful at all, make sure to drop a like and subscribe. I'll post a full recap later tonight, I think using CLF valuation metrics, debt levels, and where I think fair value sits based on their improving fundamentals. I'll also cover the SMMT biotech earnings later this week for those following the small caps. And thanks for tuning in. I don't think there's any questions. No one's really been chatting too much. I'll wait 2 more minutes. I'll say until 23, because I got a meeting soon, but it's not too pressing in time. And yeah, I think this was one of the best earnings calls I've seen of the year. I really like the CEO. I haven't even really researched him, the management, too much, but he's really well spoken. You could tell he knows the business, and you could tell he has experience inside of this type of market. All right, here we go. Lorenzo I don't want to mess that up. Chairman since 2014, which started operations in 2020. The first acquisitions. I think the acquisitions have been absolutely massive for this company. Also, they're not really they kind of undersell it in this, and I think the one mess up was the Canada one, but it's tough because of the policies, which are kind of out of their control. They don't have any control over how policy gets made, how that affects their company, because it's always going to be a thing that happens, and you're just going to have to find ways to mitigate around it, find ways to grow despite these challenges. Also, I like this guy. He was speaking well. Who was the CEO? Nah. Looks like some smart guys though. Group of smart guys they got on the team. I'll have to research it more though. I think with the stock at 17, no, not 17, 1570 right now, I think it's still a buy, honestly. I would wait for a pullback. It might pull back when market opens a little bit. Look for an entry around there. And long term, I think you shouldn't worry too much. It seems like they've found a way to restabilize. I think they're going to turn a profit next year, which is absolutely massive for this company. And I think it's the main thing everyone was looking to, and to see if it would happen. And I think it's finally closer than ever, this type of data. Oh, there you go. The Robinhood shut down. I think that's a sign for me to get off. All right, guys. I appreciate you guys hanging out with me.